Hi and welcome. I'm Steve Johnson, Chief Investment Officer here at Forager Funds, and this is a video coming alongside our March 2023 quarterly report. Thanks for tuning in. January was a really strong month for stock markets around the world and both of our funds. As reporting season and economic reality sunk in, our Australian Shares Fund gave back most of those returns through February and March, while the International Fund held on to most of them. That leaves both funds up financial year to date. It's been a rollercoaster ride, but a reasonably positive start to the financial year overall. Our quarterly report is up online, so get out there and have a read. In my cover letter, I talk about moral hazard in financial services and why depositors should actually be bailed out when it comes to banking systems in developed world economies. It's a big problem, but it's not one that depositors should be paying for. We also talk about small cap underperformance. I had a recent conversation with a CEO of a mining services company here in Australia that has been doing very, very well, only to watch its share price go south. We'll talk about that a little bit later in the Australian fund part of this video. And in our international portfolio, we talk a bit about a stock called Genus International, which similarly has been performing very well, only to watch its share price go down. As we say at the end of the Australian Fund report, something there has to give. Either the share price is going to go up eventually, or this economic woe that we're seeing ahead of us is going to start impacting those companies' profitability. For the large part, we're pretty confident that the businesses we own can navigate through this period. With that, Gareth, we'll come to you, our portfolio manager on our international fund. What was the first quarter like for the International Shares Fund?
Well, we had a good quarter. We outperformed the index by a couple of percentage points, and the index itself was up about 8% for the quarter. A couple of good things working in our favor. We had a couple of big winners, one of those being Meta that we talked about in our January letter. This is the owner of Facebook and Instagram social media sites. It hit its nadir in November. The stock was up about 50% by the end of December. It's risen almost another 80% since the 1st of January. So we've been selling down our stake quite significantly, but we still own a stake in it. It's contributed meaningfully over the quarter.
I mentioned earlier the roller coaster for stock markets in general, but that stock, multi-hundreds of billions of market cap and been all over the shop in terms of investor optimism and pessimism about it.
Yeah, all sorts of lessons in psychology as well, right? So
yeah.
The other big winner for us over the quarter has been online gambling giant Flutter Entertainment. It's really over the last 6 months the market started seeing, I think, the main points of our thesis here, which is that their US operation can grow dramatically, that their FanDuel brand in America will be the market winner, and that will be a highly profitable position for the company. Again, we've sold quite a bit of stock over the last few months.
You say that, but you look at the quarterly report, it's still the largest investment in the portfolio by some margin, and probably a similar weighting to what it was 3 to 5 months ago.
Yeah, it's less cheap than it was a few months ago. I think our confidence in our own thesis has risen as well. So, you know, there's still a nice trajectory here for this business. We're just trying to stop the position from becoming too large for us.
Yeah, and what about the other side of the ledger? It's rare that everything's going right.
Yeah, I mean, I think we have had no major blow-ups over the quarter as well, which is always helpful, and especially considering that we've had a banking crisis. It's helped that we haven't owned any banking stocks.
Yeah, it's pretty, you mentioned sort of 8% returns for the market, 10% returns plus for the fund for the quarter, and yet we've had Silicon Valley Bank go bust, a couple of other regional banks in the US in a lot of trouble, Credit Suisse, one of the world's largest banks, taken over by UBS. Be a bit of a shock that markets are up so much in an environment like that. And what do you make of this latest banking crisis?
We think it's relatively contained. This has been allowed to happen because of specific light regulatory touch on smaller banks in the US. They are an important part of the overall industry in the US. So, you know, contagion can still spread, even if it is only within smaller banks. But we've had a good scare here, and I think in many respects that makes the system a little bit less, a little bit more resistant to shocks.
Yeah, I write a bit in my cover letter about what this means for the Australian banking sector as well. I mean, one big similarity there in terms of exposure to one particular asset class, but importantly, a regulatory environment here that is much, much tougher on exactly the sorts of issues that got Silicon Valley Bank into trouble. Alex, on the Aussie fund side of things, it was a very similar January, but dissimilar February and March as results came out. What's been the general theme out there through Aussie reporting season, and particularly the implications for our portfolio?
Well, that's right. So February saw reporting season really conclude, and a couple of those companies we ended up seeing in the early stages of March. Now, one of the big issues out of reporting season this year was really wages. We were talking to companies a couple of months ago, and their availability, actually getting someone through the door and in a seat, was a problem. But what we actually saw during this reporting season was now they can get those people in, but wages are inflating at a high rate. Now we see some of the stats out of the ABS pointing to 3.6% wages growth in the private sector. A lot of the companies we spoke to are experiencing wage growth significantly above that. One interesting exception of late is that tech companies, which had been seeing at the end of last year and through that year quite significant inflation in wages, that's come right back down to a much more reasonable level.
Yeah, you and I had a meeting with a CEO recently saying you're still seeing in the monthly numbers year on year wage inflation for them that is reasonably high, but everyone that's in that business at the moment is happy if they've got a job. There's no likely wage rises coming through for the coming year. So some relief there. What else are companies doing about it?
Well, I mean, there's a difference here between whether companies can or cannot pass on these higher wage costs. So a good example of a company that has problems passing it on immediately is Integral Diagnostics, which is a diagnostics provider, a large one in Australia. Now, this business mostly has its revenue sourced from Medicare, and that is a controlled amount that the company will receive per the diagnostic specific code that they actually do on that particular day with that patient. Now that will rise as of the 1st of July. That's now been confirmed at 3.6%, which is a welcome improvement from last year's 1.6%. But wages have generally gone up substantially above that in the space that they operate, and they are now needing to increase the private contribution to those procedures as well.
Yeah, it's an interesting example of a sector that was seen as a very recessionary resilient business, and is a recessionary resilient business, but certainly proving to be maybe less inflation resistant than people had anticipated. What were some of the other key things there out of reporting season?
Well, that's right. A weaker consumer discretionary environment that continues to be discussed. And we probably have not seen as significant an impact in that space as we will see towards the tail end of this year. What we did see from Nick Scali, which is a good bellwether for the sector in terms of a large dollar item expenditure, they saw the order intake in January down by 12% from the prior January. So it's down, but it is still above their expectations and is still running at a healthy level. So there's probably more to play out in that space.
Yeah, we've been actually stepping around that very carefully and trying to find sectors that are running to their own cycle. One of those that has been doing particularly well for the fund is the travel sector.
That's right. So on the travel side, we're due to return to about 85% of airline capacity internationally into Australia by June. A lot of the businesses exposed to that space, they've already seen part of that influx, but we'll continue to see more of that into the 2024 financial year and into 2025, when hopefully the majority of pre-COVID tourism is back to Australia. Now, they have had both Tourism Holdings, a large holding in the fund, and a smaller holding, Experience Co. They both benefited from significant improvements in yield. That is the price to rent a caravan for the day or to take a skydive up in the Great Barrier Reef. Like that has increased dramatically for the business in the order of THL's numbers, 40 to 70% higher than pre-COVID. That will come down, but we believe they'll hold on to reasonably large amounts of that yield improvement.
Yeah, we've seen in lots of other sectors, higher yield times lower volume can be very, very nice when it comes to the bottom line in capacity constrained industries. A couple of other stocks that you mentioned in the quarterly actually reporting some really nice results, and yet the share price, certainly after the past few months, there was a nice positive reaction after the result, but share price coming back to earth. Do you want to just mention a couple of those quickly?
Yeah, I mean, a good examples here are Healthier and Viva, both businesses performing quite well, recovering post the COVID shutdowns that impacted them both. Viva more significantly, delivering on the targets, deploying capital appropriately in both cases, but caught up in probably a more significant even malaise than small cap companies, which is micro cap industrial businesses that have suffered significantly, have seen fund flow out of investors who typically invest in those companies, and having trouble at the moment catching a bid for businesses despite performing quite well.
Yeah, and some big wins in the mining part of small cap land has probably just added or taken away even more oxygen from some of these businesses that we think are reporting really well and very keen to follow their progress over the coming years. It has been a very difficult past 3 to 4 years to try and work out which businesses are doing well and which aren't in a first COVID disrupted, now inflationary rise in interest rate disrupted world. We'll get a much clearer picture over the coming years, which of these businesses are sustainably profitable and growing and which aren't. But in both funds, a very nice collection of businesses where we're happy with the progress. Thanks for tuning in. As always, any questions, get in touch with us on Twitter via email or give us a call. Thanks a lot.